Good day. My name is Rossouw and I'm a portfolio manager with Adviceworx Private Client Securities. I'd like to spend the next quarter of an hour talking to you about the global COVID-19 pandemic and the impact that it's having on investment markets. I'd also like to share some thoughts with you on how Adviceworx sees the way forward. This USA Today editorial cartoon encapsulates why America is faring so badly in the struggle against the coronavirus. The laissez-faire attitude of the federal government and the outgoing president's denialism have caused many citizens to flout guidelines regarding social distancing. This gung-ho mentality will sadly cost the lives of many thousands of people, as vaccines will not be widely available before the second quarter of next year. As of last night, more than 61 million people have been infected with the coronavirus, and more than 1.5 million people have succumbed to the disease. The United States remains by far the hardest hit, with over 13 million infections and more than 268,000 deaths. India, Brazil, France, and Russia make up the top 5, and America is now undoubtedly the epicenter of the disease. Good news is that South Africa has now slid down to 16th in terms of the number of recorded cases. Most of the countries that have had second waves of COVID-19 infections have quickly and decisively implemented lockdowns of some or other kind. This has generally led to a flattening of the curve. Sadly, in the United States, there has been no coordinated federal response, and new infections are now totaling about 160,000 per day. Sadly, a rise in the number of new infections will eventually translate into a rise in the number of fatalities. As could be seen on the previous slide, prompt and decisive action to flatten the curve has generally helped to soften the blow in most countries. The exception, once again, is the United States, where more than 250,000 people have now succumbed to the disease. Europe seems to have overcome the second COVID wave, but the United States is facing a grim winter. Despite strong GDP growth in the third quarter, America's recovery will be hamstrung by COVID 2.0. President-elect Biden has announced some key appointments, most notably former Fed Chair Janet Yellen as his Treasury Secretary. 2 COVID vaccines are in the approval pipeline, with more to come. Despite growing by an annualized 33.1% in the third quarter of 2020, America's economy is still far off its pre-COVID levels. GDP in the third quarter amounted to roughly $21.2 trillion compared to the $21.6 trillion at the end of the first quarter of this year. In the European Union, the measures taken to reduce the spread of COVID-19 have had a negative impact on business confidence. While the manufacturing sector, depicted by the orange line, still registered a bullish 56 in October, the services sector number declined to 42, dragging the overall PMI number, depicted in dark blue, down to a negative 45. America's sharp economic recovery in the third quarter has seen unemployment come down from its peak of 14.7% in April to 6.9% at the end of October. Sadly, 11.1 million Americans are still unemployed. That's 6.3 million more than the number in February of this year. November has been a good month on most stock exchanges. The Dow Jones has breached the 30,000 level for the first time, and most major indices are at record levels. Emerging markets are doing better relative to Wall Street, and industrial metal prices are rising strongly. Brent crude oil is above $43. General Motors has been forced to recall 7 million vehicles, and thanks to the sharp rise in the Tesla share price, Elon Musk is now the world's second richest man behind Jeff Bezos. With a few notable exceptions, including the FTSE 100 in London, most major global indices are now back above their pre-COVID levels. This is certainly true of the S&P 500 in New York, the Morgan Stanley All Countries World Index, and the Morgan Stanley Emerging Markets Index. Gold has sadly come off of late, and the gold index is now down by nearly 50% over the past 3 months. Despite much talk about mean reversion and rotation out of growth stocks into value stocks, most of the running in the S&P 500 is still being made by big technology companies. This graph shows that out of all the S&P 500 constituents, only about 30% of stocks have outperformed the index. After the initial COVID-19 induced sell-off in March and April, the US market recovered strongly and most of the world's equity markets lagged behind. In recent times, however, a return of risk appetite has seen the emerging market index slowly but surely catch up to the S&P 500. Equity and commodity markets famously try and anticipate the economic reality 6 to 9 months ahead. They thrive on good news and certainty. The gold market, on the other hand, thrives on uncertainty and cheap money. This graph shows how the return of confidence has seen the price of copper go up in recent months, while the gold price has gone steadily down. Looking ahead, we believe that global economic activity will only return to pre-COVID levels in the second half of next year. Equity markets will be supported by cheap money and economic recovery, with gains no longer limited to only technology stocks. As fear subsides and is gradually replaced by greed, emerging market equities and bonds should attract portfolio flows. A more settled investment climate will, however, not be good for alternative assets like gold and cryptocurrencies. One of the past week's big local news stories was former President Zuma's appearance before the Zondo Commission. When Deputy Chief Justice Zondo refused Zuma's request that he recuse himself, the man known as Msholozi promptly absconded. This landed him in hot water, as Judge Zondo then reacted by laying a criminal complaint against him. To be continued. As of last night, nearly 780,000 South Africans had tested positive for COVID-19 and 21,289 people had succumbed to the disease. Of particular concern is the fact that more than half of all new infections are in the Eastern Cape, with its notoriously weak health infrastructure. There are also worrying signs of a resurgence in the Western Cape, where new cases have increased by 52% over the past week. Last week, Moody's and Fitch downgraded South African bonds further into junk territory. Inflation rose in October due to food prices. The Reserve Bank forecasts that our economy will grow by 3.5% next year and that inflation will remain below 4%. Retail sales recovered by less than expected, and the spats in the ANC over policy and power continue. It remains to be seen whether inwardly listed ETFs and ETNs reflecting offshore assets will be counted as South African equities going forward. Last month, the cost of food and non-alcoholic beverages increased by 5.4%, which resulted in the lifting of overall CPI from 3% to 3.3%. This should not be cause for too much concern, as the good summer rain that South Africa is currently receiving should result in a moderation of food price inflation. According to the South African Reserve Bank's latest forecast, South Africa's GDP is expected to contract by 8.2% in 2020. This will be followed by growth of 3.5% in 2021 and moderate to 2.2% in 2022. This is way below the levels of 6% per annum required to reduce poverty and inequality. The Reserve Bank had better news on the inflation front. Headline CPI is expected to remain below the 4.5% midpoint of its target band of 3 to 6% for the next 2 years. November has been good to the JSE thus far, and the all-share index is finally positive for the year to date. Banks were the star performers and gold the worst. The rand and bond market have both shown resilience despite the ratings downgrade. Takealot managed to grow revenue by 41% in the 6 months ended September. Netcare, however, announced that its full-year profit was down 58.4%, and Bitcoin is above $19,000 for the first time in 3 years. The JSE All-Share Index is finally positive for the year to date, only just. This is largely due to the performance of the resources sector as well as process and Naspers. Recently, one of the best performing sectors has been banks, which managed to claw back a lot of the ground lost in March and April. The gold mining index has been massively volatile over the past year. Although it is still up more than 50% since November last year, the wheels have come off in recent months, and the index has lost nearly 40% of its value over the past 3 months. During the past month alone, it declined by more than 20%. The rand, depicted in dark blue on this graph, seems to have shrugged off the recent ratings downgrades and keeps on firming against the US dollar. It is currently trading at levels between 15 Rand 10 and 15 Rand 20 to the US dollar, and this makes it one of the best performing emerging market currencies relative to the greenback, along with the Indian rupee, the Indonesian rupiah, and the Chilean peso. Although the rand's recent strength against the US dollar is heartening, it has to be said that this is largely due to a weak dollar rather than a strong rand. The same is true of the performance of the rand against the British pound. Both of these heavyweight currencies are currently experiencing a period of weakness, and the rand is not appreciated nearly as much against the euro, which is depicted in blue on this graph. Last week saw continued foreign appetite for South African bonds, and foreigners were net buyers of South African bonds to the tune of 3.82 billion rand. Sadly, more than 6 billion rand flowed out of the JSE over the same period. Looking ahead, we expect the advent of COVID-19 vaccines to inspire economic normalization. This should see currently unpalatable sectors attracting investors once more. Monetary policy is likely to remain expansionary with interest rates remaining low. There is definite value to be found in the local equity market, but the underlying economy needs to improve for this to be unlocked. The rand is starting to look overvalued, and the rally in local bonds could eventually be undone by fiscal weakness. The Adviceworx PCS asset allocation view can be summarized as follows. Because of the economy and the weak rand, we remain overweight global equity and underweight South African equity. We remain neutral on global property where valuations are reasonable, but negative on South African property. We hold no global fixed income, and we remain overweight South African bonds. Thank you very much for your time and attention. We certainly live in interesting times, and I hope that this presentation will help you make sense of them. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I hope you'll have a lovely day and a splendid weekend. Until next week, goodbye from me.